A decline in the money supply is rare. Something strange has been happening to the money supply because for about a year and a half the total money supply was constantly decreasing, and the rate at which the money supply was contracting was echoing recessions and depressions of the past. But during the last couple of months of 2023 and the first few months of 2024, the decline in the money supply has reversed and begun to grow yet again. This is something most people have not caught on to, simply because of the fact that a decline in the money supply is actually so rare in recent US history that it's been gaining all the attention recently. If we look back since the 1980s, we have never seen a time in which the money supply contracted until April of 2022. In fact, we have to go all the way back to 1948 before we see a brief contraction of the money supply, and before that a contraction in the money supply was quite common. But for months now the money supply has actually been increasing again. The question is why? Why is the money supply contracting? Well, we can see that this recent re-expansion of the money supply has started to impact prices month over month. Inflation in consumer prices have started to increase at a faster pace than expected, with year-over-year inflation in January of 2024 at 3.1%, which was higher than what people expected at 2.9%. This means the rate at which prices have been increasing on average hasn't really changed since June of 2023, and again, this doesn't mean that prices are not changing. This means that prices are going up at a consistent pace, a little over 3%, which is odd, considering the money supply wasn't actually going up until the very end of 2023. We have a ton of puzzle pieces that we're going to need to put together here. So let's start off with what actually causes a change in the level of prices. There are many things that contribute to prices, but you can think of prices as information regarding the ultimate scarcity or abundance of something relative to everything else. For instance, if half of the wheat crops in the world are wiped out tomorrow, then we know that the price of bread will probably go up, because we can't make as much bread as we used to, because there's less wheat. The prices will go up until we find a new equilibrium point at which people are willing to pay the higher prices, and some people are not willing to pay the higher prices, so they don't buy. Ultimately, the prices communicate that information, and it lets people make decisions about whether they're going to continue consuming something or not. We only have half the wheat, so we can only consume half the wheat, because you can only consume something that has been produced. Prices going up are the most fair, most efficient, and most effective way to decide how that increased scarcity will be allocated. But obviously, we don't live in a completely free market. In fact, most things that we buy and sell on a regular basis have other things influence in their price other than just free market scarcity or abundance. Things like regulations, taxes, tariffs, subsidies are all in influencing whether something is artificially higher in its price or artificially lower in its price. As an example, when our US government decides to send hundreds of billions of dollars to a foreign country for a war, and they turn around and spend that money on arms manufacturers here in the United States, those arms manufacturers then increase the scarcity by taking some supply of things like steel, aluminium, gasoline, oil, plastics, and rubber, electronics, and they ship those off to the foreign countries just to be exploded and destroyed, thereby increasing the scarcity of those items and materials for everybody else, increasing the price, and so all across the world we have inflationary forces that are pushing up the price of things by soaking up some of the abundance by increasing their scarcity. But obviously, we have the money supply is one of the largest factors that contributes to inflation or deflation. This is why, despite technological advancements and innovations over the past decades, we've seen the cost of living continually rise, because the amount of money in circulation continues to rise. But that all changed in April of 2022 after a historic increase in the rise of the money supply. The Federal Reserve Court religion started to try to decrease the money supply for the first time in recent history. We can see that they were successful with it for about 1 year, from April of 2022 until about May of 2023, and then the money supply started to move sideways real quick. I want to let you guys know that in just under 2 weeks from today, I'm going to be hosting a completely free live online event. It's going to be a webinar covering how all of this fits together. We'll be discussing how the Federal Reserve will try and fail at putting a lid on inflation as soon as the economy starts to break, and how what the federal government is doing is actually pushing the financial system closer towards something breaking. We'll talk about the overall context, how this fits into the long-term debt cycle, because we've seen these things play out many times throughout history. There's a pattern at play here, and it's playing out again today. And obviously, above all, we're going to be talking about how to actually profit from all this. The event is going to be on Thursday, March 7th, and spots are actually limited. I know people always say that, but it's actually a Zoom limitation on the webinars. There's only 500 slots and they're already starting to fill up. So if you're interested in joining, go to the link below, sign up now. How the Fed contracts the money supply. See you there. So the question is, how does the Federal Reserve do this well? Now we're looking at a chart of the Federal Reserve's balance sheet, and this is their main tool for affecting the money supply. When their balance sheet is increasing, it means they are printing money to buy assets from banks, and then those banks can, if they want to, turn around and buy other assets from other people like the United States government. This is called quantitative easing or debt monetization. It's where the central bank creates new money out of thin air to buy assets out of the economy, and in place of those assets they insert cash. Then those financial institutions that they gave the cash to for those assets had the freedom to turn around and do something else with them, which is usually just make new loans. They buy new assets instead. So while the Federal Reserve's balance sheet is going up, this is creating the opportunity for more cash, more liquidity in the economy. This also means that when the Federal Reserve balance sheet is declining, the opposite is happening. When the Fed's balance sheet is declining, that means they're letting some of that debt get paid back to them, and they're not rolling it all over. It means they're not taking that cash and loaning it all back out again. Some of that debt is actually retiring, which means the amount of dollars the